We're here today in the studio with Ross DeVol. Ross is our Executive Director of Economic Research. Welcome, Ross.
Thank you, Jennifer.
Now, you're just putting out your economic forecast for the U.S. Tell us about it.
Well, we've gone through a thorough econometric analysis looking at factors leading up to the recovery, which we believe we're in, and we have concluded that we are in the beginnings of a mild economic recovery. Nothing to get excited about, but it's certainly not a double-dip recession. We look for GDP growth this year in 2010 around 3.5%, and then in 2011 3.7%, and 2012 3.8%. Now that's certainly below the normal rate of recovery from a recession of the severity.
So let's get down into some more details about that, because obviously there's kind of a doom and gloom sentiment out there. But let's look at what you found, perhaps in jobs or consumer spending.
Right. Well, of course, the missing piece of the recovery has been private sector jobs. Earlier in the year, there was a lot of anticipation that we might see stronger private sector job growth. Back in March, we got a number over 200,000 private sector jobs have been added. I, at the time, thought that was a bit optimistic. That really wasn't the underlying trend. Subsequently, we've had reports come out that show lower rates of growth in that. But overall, we expect somewhere around 1.8 million jobs to be added in 2010, and almost, well, 3.1 million in 2011, then falling back to the 2.5 million range in 2012. But that is really the key to sustaining the recovery, is private sector job growth. We think we're in the early stages of that, but it's still not clear that that's going to happen.
And so what are the key drivers that you found for this economic growth?
Well, what we've seen is that businesses have been investing in information technology equipment at a very high rate. We're seeing double-digit growth rates in IT equipment, the things that Cisco and Intel sells, and their figures have been very strong. Also, export growth has been quite phenomenal. We had a large fall off during the recession, but so far, if you look year over year, relative to where we were last year at this time, exports are up 25%. And once again, they're principally going to Asia, China, and it's just growth across the board, not only heavy equipment that Caterpillar sells, but also Cisco, information technology, Dell, you name it, it's going overseas.
And with all of this good news, how does this economic recovery compare to the historical trends, and why is that important?
Well, it's important. Overall, we're still expecting a fairly weak economic recovery compared to previous recoveries. One of the reasons for that is that typically in the past, the recovery has been in proportion to the rate of decline. So if you had a large decline during a recession, it means there's a lot of pent-up demand for consumer items such as cars and appliances, and also businesses have postponed important investments, which they begin to recover. So we still think that's going to happen, but not at the normal rate of recovery. We think this will be the slowest rate of recovery in the post-war period, but certainly not synonymous with a double-dip recession.
Well, definitely moderate but sustainable recovery is actually a positive news in this cycle that we've seen, isn't it?
It is. We've seen a lot of gloom and doom in the headlines. I think it's been overly pessimistic. One of my biggest fears is that we will talk ourselves out of recovery because the underlying fundamentals are much stronger than the public discourse would suggest.
And I know many of those fundamentals, a lot of good data on a variety of areas, including housing, business spending, is all included in the report, which is available at www.milkeninstitute.org. Thank you, Ross.
Thank you, Jennifer.